Good afternoon, everyone. Let's wait for a few more minutes to start, right? Okay, good evening to all.
Good morning. Good evening, ma'am.
Good evening. Good
Good
evening.
evening, ma'am. Good evening.
Good evening. Okay, today we'll be discussing about risk and return. Okay, these two aspects we usually refer daily, right? And we, I hope you you might have invested in some shares. You might have invested shares, or you may be having some assets like gold or land, building, like that, right? And from all these investments, we expect return. And we know that return and risk are like two sides of a coin, right? Okay, we can have return, but we have to bear some risk also. So that you know the importance of risk and return in day-to-day activities and even in financial activities, right? Okay, let us go to the details of risk and return. I hope my screen is visible to you. If possible, you can uh, have response. Those who are uh, free to respond, you can respond. Okay. My
This
screen
one,
is
rate
visible.
of return,
I get you.
the rate of return, that's what you're asking. Or risk and return. There is two.
Risk and return, right? You can see the slide,
Yeah,
right?
that we,
Okay.
yeah.
Okay.
Like a ma'am, it will be the example for like a medicines also we can count, na? Like it will be like a if it will be not like it's a expiry, so we return or like it will be the risk also.
Yeah, definitely.
Like for example, I will count that.
Yeah. Let us go to the conceptual definition of return and risk. Then we will have a discussion, right? Yeah, what do you mean by return, basically? Return means, okay. Can you, you want to ask me something, or otherwise, can you please keep it on mute?
Ma'am, please continue.
Okay. Return with respect to financial aspect is the appreciation we expect from an investment, right? Okay, what do you mean by investment? Investment means you may buy a share, or you can buy assets like gold, or you can have investment in commodities and precious metals like gold or diamond, or you can buy land, building. From all these investments, we expect an appreciation in the value, right? That is what is financial return. And why we expect a return? Why we expect a return? Because in every investment, you are sacrificing your present consumption, right? If you purchase a share, or if you're going to buy a land or a building, everywhere you, or if you're going to start a new business, everywhere you are sacrificing your present consumption. Usually, we all invest from our savings, right? Usually we uh, invest from our savings, and sometimes we may take loans and invest, right? In every aspect, we expect an appreciation. That is what is financial return. Then what is risk? This is the counterpart of return, right? Without risk, you cannot have return, right? And we usually say it like higher the risk, higher the return, right? That is our expectation. And let us see the definition of risk. In simple terms, risk is a possibility of something bad happening in the future, right? And why we expect risk with respect to all your investments? Because it's a sacrifice. Otherwise, you can consume that money now itself, and you can enjoy that. If you made an investment, you are sacrificing your sacrificing your current consumption, and you are investing it to get a return in the future, right? And we know that future is always uncertain, because whatever we know what will be happening in the future, right? Sometimes you may be investing it for a very short period, maybe for 6 months, or maybe for 1 year, or maybe for a long-term period like 10 years, 20 years, like that, right? Every work, we know that future is always uncertain. Anything can happen in the future, right? You may lose your entire money, or positively we can think like you can double your money, or you can have returns in many folds, right? Okay, that is why we expect a risk also, since the future is uncertain. And okay, in financial terms, how do you define risk? Risk is the deviation from your expectation, right? With every investment decisions, you have some expectations, right? There will be some expected return in your mind, and it can change in the future also. Whenever what are the risks we expect, like inflation can happen, and in the stock market also, stock market crash can happen, and you may be knowing about stock market bubbles, asset bubbles, right? Yeah, all these can happen. That's why risk is inevitable with respect to returns. And in financial terms, how will you define risk? Risk is a deviation from the uh, actual return, right? Okay, the expected return uh, can deviate, the actual return can deviate from expected return. That is what is risk with respect to uh, financial terms. Then, okay, we can define risk and return with respect to many aspects. There are different kinds of calculations and expressions for both risk and return. Okay, in today's session, let us discuss a few aspects of risk and return in detail. Okay. First, let us explain return. Okay, have you heard of ROI? What is it? ROI, return on investment, right? We usually refer this term, return on investment. What is this? It is the benefit of an investment divided by the cost of the investment. What do you mean by benefit? Benefit is your return that divided by cost. And we usually express this in terms of percentage or a ratio. The formula we use to calculate return on investment is current value of investment minus cost of investment divided by cost of investment. Okay, this is the most common calculation we use to express return. A return on investment is a general calculation we use to express the return of an investment. There are other expressions also. Let us go through that. Okay. Let us go through a simple example to show what is ROI, return on investment. Okay. Let us discuss about Mr. A. He invested in ABC Corporation $1,000 in 2022, and he sold his shares for an amount of $1,200 one year later. In 2023, he sold that shares for $1,200. What is his return? Okay, we have to calculate return on investment, right? Hope you remember the formula. What is the formula? Current value of investment minus cost of investment divided by cost of investment. What is the current
Sorry, ma'am.
value of investment?
Ma'am, can you
Yeah.
explain me for this formula how to we do it?
Yeah,
Can
this
you
is a formula. This is a formula. Return on investment is equal to current value of investment minus cost of investment divided by cost of investment. Hope you got it.
Yes, ma'am.
If you want, you can. Yeah. Then let us go to an example. Excuse me. Okay. In this example, Mr. A purchased, or purchasing is an investment activity, like right? Purchasing of a share is an investment activity. He invested $1,000 in ABC Corporation in 2022, and he sold it for 1,200. Hope it is clear. And let us calculate the return on investment here. How will you calculate the return on investment? 1,200 is the selling price, right? Minus 1,000. 200 is this difference, right? Selling a capital gain divided by the investment. Then what is the ROI? Okay, we usually express this with respect to percentage or ratio. That's why we multiply it with 100. Then 20% is the ROI, right? Hope it is clear. And let us go to another example.
Ma'am, but why 20%?
20%. 200 is the difference, right? 1,200
Yes,
minus
yes.
1,000. 200 divided by 1,000 is the purchasing price. Got it?
Okay, okay. Yes, yes. Ma'am.
Into 100. Then you will get 20%, right? Why we multiply it with 100? Because the usual expression of ROI is in terms of percentage or ratio. That's why. Clear, right?
Yes, ma'am.
Yeah, let us go to another
Yes, ma'am. Clear.
example. Yeah, let us go to another example. Okay, the same. Let us compare this investment with another. He can usually we buy 2, 3. We will not restrict to the purchasing of a single share. You know the concept of portfolio and all, right? To get the balance, to get the risk balanced, we buy few other shares also, right? Otherwise, if something happens to that share, we have to bear the entire risk, so that we can purchase other shares also. Okay, here he is also investing in ABC Limited, sorry, XYZ Limited, and how much was the investment? He also made an investment of $2,000 in XYZ company into 2022 and sold the shares for a total of 2,800. Then what is the difference here? What is the capital gain? 800, right? 2,800 minus 2,800 is the capital gain. Then how will you calculate the ROI? 800 divided by the purchasing price, 2,000, right? 800 divided by 2,000. And how much is the ROI here? ROI 40%, right? You'll get 4 as answer into 100. 0.4, right? Got it. In the previous example, he got an ROI of 20%, and from this investment, he got 40%. Yes, likewise, you can compare the investment and you can
Yes,
compare.
yes, yes. Yes, ma'am. Understood.
Yeah. Then, okay, let us. This is with respect to an investment in shares. If we can apply the concept of ROI in another context also. Okay, this is an example of a small restaurant, and they want to begin investing in a digital marketing campaign. Okay. This is also an investment, right? Okay, you can have, when we discuss about investment, we can have individual investment or personal investment, or we can have corporate investment also. The first two examples were individual investment or personal financial investment. Okay, this is an example for corporate investment, right? Companies can also take decisions with respect to investment. This is an example of that. This company wants to invest a particular amount with respect to digital marketing campaign. Why they invest in digital marketing campaign? Because they expect that by doing a digital marketing campaign, they can increase their sales. That is why they are planning to invest in digital marketing campaign. And how much will be the expenditure for that? $20,000, right? That is also a kind of investment. Spending $20,000 for digital marketing campaign is also an investment. Hope it is clear. Then what is their expectation? When they spend 20,000, what is their expectation? They expect their sales to increase by $60,000, right? Then how can we calculate the ROI of this investment? The difference, 60,000 is the expected return, 20,000 is the investment, divided by 20,000 into 100. Then how much is the ROI? 200%. Then we can go ahead with the decision, right? Will you go ahead with the decision to invest $20,000 in digital marketing campaign? Okay, this is another application of ROI. So far, we have discussed ROI in two contexts. One is personal financial decision, And this was a corporate financial decision. Then there are similar terms like ROI. Okay, let us discuss another term, ROE. What does it? ROE means return on equity. Okay, let us see the difference between ROI and equity. The formula to find ROE is net income divided by shareholders' equity into 100. Okay, why we are concerned about shareholders? Why? Shareholders are the owners, right? Okay, ROI will give you a general idea about the investment's feasibility. Why we consider shareholders? Because they are the owners, right? Okay, because the companies will raise fund from the general public, and by purchasing the shares, they are becoming the owners. And it is the responsibility of the business to give a portion of the profit to them. How will they give the profit? Usually in the form of dividend, right? That's why shareholders are also important, are the important aspects with respect to a company. That is why we use ROE as an investment calculation. ROE measures the profitability against shareholders' equity. And this will give a clear picture of the business investors if the management can utilize the company's assets to drive the top line and bottom line revenue and generate a healthy returns to the investor. And okay, let us discuss another case. Let us revisit our small restaurant example we have seen in the previous slide. Suppose they have $1 lakh as equity shares, and their net income for the previous financial year is $25,000. And how will you calculate ROE? What is the formula? Net income divided by shareholders' equity into 100, right? What is the net income here? During the previous financial year, the company generated a net income of $25,000, right? $25,000 divided by shareholders' equity is $1 lakh here. Then you can multiply it with 100. Then what is the ROE here? 25%, right? Okay. This is another expression of return. Then hope this is also clear. If you have any doubt, you can ask. Okay. This another expression of return is like return on capital employed. Return on capital employed. So far we have discussed ROI, return on investment, return on equity. Another expression of return is return on capital employed. Let us see how we can calculate return on capital employed. This is calculated by dividing the net operating profit or earnings before interest and tax by capital employed. Okay, how will you calculate return on capital employed? Either you can do it like net operating profit divided by capital employed or earnings before interest and tax divided by capital. Okay, then you can compare it with this. Okay, there may be, hope you know the difference between a firm and an industry. Firm is a single company and industry is a group of similar firms, right? Like IT industry, FMCG industry and all. You can compare, if your company belongs to IT, you can compare the ROE of similar firms in the same industry. That is how you compare the feasibility or the profitability of your business. Then another expression of return is return on assets. Return on assets. This is another way of expressing return. And this refers to financial ratio that indicates how profitable a company is in relation to its total assets. Okay. And the formula is like net income divided by total assets. What do you mean by net income? Net income means income minus expenditure. That is what is net income. Then, so far we were discussing the general aspects of return. What all formula we have discussed so far? What all formula? ROI. Hope I am audible, right? Okay, we have discussed about ROI, ROE, then return on capital employed and return on assets. Then, okay, let us go to the aspect of risk. Okay, before going to risk, we can have another expression of return. Okay, usually we all invest in fixed assets, fixed deposits, right? Okay, what is a fixed deposit? Usually we invest a lump sum amount within a bank, and there will be a lock-in period like 5 years, 7 years, like that, right? And from a fixed deposit, what all income streams you expect from a fixed deposit? What all income streams, or what are the advantages of investing in a fixed deposit? Can anyone respond? What are the advantages of investing in a fixed deposit? You can expect a regular return, and at the end of the completion or at the end of the maturity, you can get the capital back, right? That is the advantage of investing in fixed deposit. You will get a regular shares, or like equity shares or preference shares, or you can also invest in debentures or derivatives also. There is an investment opportunity with respect to derivatives also. Okay, whenever you invest in equity shares, you can expect two kinds of income there, like regular return as well as capital appreciation. What is a regular return you expect from a share? Dividend, right? Dividend is a regular return, and if you want to sell sell the shares later, you will get the capital appreciation also. And what is your expectation with respect to an investment in debentures? From debentures, you will get a regular return of return like interest, and at the end of the term, at the end of the maturity, you will get the amount back, right? Okay, like that, we can differentiate return into two aspects: regular return plus capital appreciation. Okay, that is also another way of expressing return. Then, shall we go to the concept of risk? And what is the general definition of risk? Risk is about the uncertainty of the future, right? Risk is about the uncertainty of the future. And in financial terms, we can refer risk as the variability of your actual return from the expected return, right? Then, this is another categorization of risk. Usually, everyone talks about the total risk, but it has two important components like systematic risk and unsystematic risk. Have you ever learned this concept, systematic risk and unsystematic risk? Or is this a new term? Can anyone respond? Have you learned this before?
No, madam.
No, okay. Okay, someone has asked me to repeat the topic. Hope you got the concept, right? Someone has joined later. Okay, so far we were discussing about the return aspect of an investment, and in that we have explained return on investment, return on equity, return on capital employed, and return on assets. Now we are going to discuss about risk, and the total risk can be categorized into two: systematic risk and unsystematic risk. Okay, I'll explain what is systematic risk and unsystematic risk. A systematic risk is the component of total risk which is uncontrollable in nature. Okay, uncontrollable means we cannot control that risk. We have to bear that risk. Somehow we have to bear that. Can you give examples for that? Suppose you are going to invest in shares, or if you're going to invest in uh, any of the investment avenues, you have to face inflation, right? Inflation you cannot control because it affects the entire system. Okay. Those risks which affects the entire system is known as systematic risk. That is an external risk, because we can control only the internal aspects, right? External aspects we cannot control. Those aspects which are external to our control are known as systematic risk. For example, purchasing power risk, inflation risk, and like we all have experienced the COVID pandemic, right? That is also external. We cannot do anything with that. Everyone has to suffer, right? Those kind of risks are known as systematic risk. And why we call such risk as systematic risk? Because it affects the entire system. That is why it is known as uncontrollable and external. And there are some risks which we can control. And such risks are known as unsystematic risks. They are internal in nature and we can control also. That is why such risks are known as unsystematic. Unsystematic risk means it doesn't affect the entire system. It may affect some firms in the industry, so that we can diversify that risk. How can you diversify your investment? You might have heard about creating portfolios, right? Why we create portfolio? Instead of investing in a single share, you can divide your savings, and you can divide your investment and put your savings into different shares. Like that is what is portfolio. Why you're doing like that? You might have heard like, okay, if you put the entire eggs in a single basket, something happens to that single basket, your entire eggs will be lost, right? Okay, for that you can keep your eggs in different basket, so that if something happened to one basket, will not affect the other basket, so that you can save few of your eggs, right? Like that, in investment also you can diversify your investment. That is what is portfolio. Hope it is clear. What are the two components of total risk? Systematic risk and unsystematic risk. Systematic risk means which is uncontrollable and affects the entire industry or the entire mass market. And since it is external, we cannot do anything. We have to bear the risk. Unsystematic risk means controllable risk, internal risk. Okay, if you see that if you know that there is raw material availability to a particular industry, and when you search for shares to invest, you can do one thing. You can eliminate that uh, industry or a particular firm from your list, right? And you can opt good companies only. That is how you diversify your risk, right? Okay, that is what is unsystematic risk. Hope this is clear. Then, okay, these are the examples of systematic risk: interest rate risk, market risk, and purchasing power risk. So what is market risk? Interest rate risk, whenever you take a loan, you have to pay the interest. and interest is not always stable. It keeps on changing according to the monetary policy of the country. It keeps on changing, right? And there is a interest. Interest has two aspects. If you are investing somewhere, you will get interest for your deposit, and if you take loan, you have to pay the interest, right? If the and usually, which interest rate will be more? Interest rate on deposit or interest rate on loan? Which one will be more or higher? Interest rate on loan will be higher, right? And that is why, because there is a market principle, like market takes more and gives you less. Okay, like if you take loan from the market, you have to pay more interest to the market, and if you deposit in the market, you will get less interest, right? That is the principle of the market. Market always takes more and gives you less. Then what is market risk? Market risk is the risk which affects the entire market. And what is the expression of market risk? Those who have invested in shares may be knowing beta. Have you heard of beta? Beta value is the term which represents market risk. And usually systematic risk is measured using the term beta. Then purchasing power risk. What is purchasing power risk? Purchasing power. This is due to what? Purchasing power risk is due to the inflation, right? Sometimes you might have purchased something for 100 or $10 in the previous year, but when you now go and ask for the price, it may be $105, or it might have increased. Why there is that much hike in price? Because of inflation, right? And because of inflation, your purchasing power is getting reduced. That is what is purchasing power is. I hope you got the examples of systematic risk, interest rate risk, market risk, and purchasing power. All these are uncontrollable. Okay, as an individual, we cannot do anything with respect to interest rate risk, market rate risk, and purchasing power. That's why it is known as uncontrollable and systematic risk. Why systematic risk? Systematic risk, these risks affect the entire system. That's why it is known as systematic risk. Then, okay, let us go to the examples of unsystematic risk. Okay, as I told you earlier, if you want to purchase the share of a particular company, you can check whether that company is facing issues like raw material scarcity, or are they facing any labor strikes or labor unrest, or is there any management inefficiency? If you feel that the CEO of a particular company is not doing well, you can expect their shares going down in the future, so that you can avoid that company to invest. You can opt for another company. Okay, these kind of risks are known as unsystematic risk. Okay, why these risks are known as unsystematic? Because this doesn't affect a particular industry, or it doesn't affect the entire market. Okay, these risks are firm specific risk. Hope it is clear. These risks are firm specific risks, so that you can avoid that particular firm or a particular industry, and you can opt for another industry or a firm. Okay. And how you can reduce unsystematic risk? Unsystematic risk can be reduced through diversification. Okay. Then how unsystematic risk is happening? Or what are the reasons for unsystematic risk? Unsystematic risks are firm-specific risk, right? And this can happen due to two things, like operating environment of the company and financing pattern adopted by the company. What do you mean by operating environment of the company? Operating environment means here basically we refer to two types of cost. Like there are two types of costs, like fixed costs and variable cost. And what do you mean by fixed cost? Fixed cost means, suppose you have a building, you have purchased a land and you have invested in machinery, plant and machinery and all. You might have invested in another permanent assets. And even if there is no production, you have to bear all these, or you might have taken a building for rent, and even if there is zero production, you have to pay the rent, right? And there may be like there may be employees, permanent employees. You may have to pay the wages or the salary, and salaries are usually fixed. Even though there is no production, you may have to pay the salary. Okay, and if you keep the fixed expenses at a higher level, and you don't have that much production, you have to bear the expenses. And operating cost, if it is high, that will affect your profitability also. That is one of the reasons for unsystematic risk. And another reason is financing pattern adopted by the company. What do you mean by financing decision of a company? Financing means from where you raised your capital. Okay, it can be through shares, or it can be through debentures, or you might have taken loans also. Okay. Financing pattern means if you have debt fund at a higher level, and if you don't have enough profit, you know the difference between equity shares, preference shares, and debentures. For equity shares, since they are the owners, if there is no fund to be distributed, or if there is no profit to be distributed, it's not mandatory to distribute the dividend. But for a debenture holder, it is mandatory to pay off the interest. And if you keep the debentures, or if you keep the debt capital at a higher level, and if you don't have any profit to cover up that interest, you will be in trouble. Okay, these are the two reasons for unsystematic risk. And unsystematic risk is firm specific, and the reasons for unsystematic risk is due to the operating environment of the company and the financing pattern of the company. Is there any doubts here? Shall I continue?
Okay, ma'am.
Okay. Then, okay, let us go to the next slide. Okay. Then I told you, no, the unsystematic risk is due to two things, like operating environment as well as a financing pattern. The risk related to operating environment is also known as risk. And as we discussed, we have two kinds of cost: fixed cost and variable cost. And the business risk or the operating risk is arising because we keep fixed costs at a higher level. Then we usually use a term called leverage. Leverage means it is the ability of the firm to employ new assets or funds to create a better return to reduce the cost. Leverage means it is the process of including debt in the capital structure. And even though debt is a liability, debt has some advantages. Okay, what are the advantages of debt? Because debt means for debentures, you have to pay interest, and the interest rate is always fixed. And the equity shareholders, since they are the owners, they may have more expectation, and the cost of capital for equity is higher than that of cost of equity, because they will be having more demands as they have to bear the risk. But compared to equity shareholders, debenture holders are safer, so that their expectation will be lesser. That's why we, in most of the cases, we consider debt as a cheaper capital. Then here, leverage means including either fixed cost or fixed capital bearing funds like debt. And leverage can be of two types, operating leverage and financial leverage. Okay, why we are discussing leverage here? Because we are discussing about risk, right? And risk can happen due to operating environment of the company as well as the financing pattern. That is why we discuss leverage here. And leverage, we can have two types, operating leverage and financial leverage. And in combination, we can call operating leverage and financial leverage together as combined leverage. Okay, let us differentiate operating leverage and financial leverage. Operating leverage can be defined as a firm's ability to use fixed cost or expenses to generate better returns. Okay. It is not feasible for the firm to go for entire equity, because equity means if you are selling an equity share, that equity shareholder is becoming the owner, right? And they are getting a voting right. They are getting rights also, so that they will be more demanding. But when you have debt capital, you may have to pay a fixed interest, but comparatively it is cheaper because they may not be expecting more. They will be expecting only their fixed interest. That's why debt is also good for the firm. And what is operating leverage? Operating leverage is defined as a firm's ability to use fixed cost to generate better returns. And we know that debt is a cheaper capital, but adding more and more debt is not feasible. You should keep a limit for the debt. Okay? And if you go on adding debt to your capital, that will increase your liability. You will be in a debt. Operating leverage is your ability, is a firm's ability to use fixed cost and generate better income from that. And what is financial leverage? Can be defined as a firm's ability to increase better returns and to reduce the cost of the firm by paying lesser taxes. And the financial leverage is due to the inclusion of debt in your capital, right? Operating leverage is because of fixed cost, and financial leverage is because of fixed interest bearing funds like debentures and preference shares capital. And what is the advantage of debt? Debt is comparatively cheaper, and we have another advantage for debt. What is that? It gives you tax benefit, right? Okay, you have to pay tax only after distributing the interest to the debenture holders. That is another advantage. And the financial leverage will tell the firms, will give you the firm's ability to increase returns and to reduce the cost by paying lesser taxes. I hope these two are clear. Operating leverage is due to the inclusion of fixed costs. Financial leverage is due to the inclusion of debt. Fixed cost and debt are good, but you have to keep a proper balance. It should not be you should not keep fixed cost as well as fixed interest bearing funds like debt at a higher level. Okay, that is what is operating leverage and financial leverage. And what do you call this as combined? Combined, we can call this as combined leverage. And okay, all these things we have discussed. Operating leverage measures the operating risk of a business. Financial leverage measures the financial risk of a business. Then operating leverage is about fixed cost of the firm, and financial leverage is about the capital structure of the firm. How much debt is in your capital structure? That is what is financial leverage. How will you calculate operating leverage as well as financial leverage? Operating leverage can be calculated when we divide contribution by EBIT of the firm. Contribution, hope you know what is contribution. Financial leverage can be calculated when we divide EBIT by EBIT of the firm. earnings before interest and tax divided by EBT, earnings before tax. Then regarding the impact, when degree of operating leverage is higher, it depicts more operating risk. When the degree of financial leverage is higher, it depicts more financial risk. Okay, what is the ideal figures? Lower the ratio, higher the profitability, or the risk is less. Then should we completely avoid these leverages? We need not completely avoid this leverage, because leverage, while the term leverage, we mean that it is a firm's ability to utilize either fixed cost or fixed interest bearing fund to generate more profit. It doesn't mean that you should completely avoid the investment in fixed cost or debt capital. You can have fixed cost as well as fixed interest bearing funds, but you should keep a proper balance. Then, yeah, let us have another expression for leverage, risk. Okay. Here we have discussed about, let me go to the previous slide. Here, risk, right? You can see total risk here and the components also, systematic risk and unsystematic risk, right? Okay, how will you measure systematic risk? This is uncontrollable. We cannot do anything with that, even though we can measure systematic risk. How will you measure systematic risk? Which is a notation we use. I told you, no? Hope you remember. Beta. Using beta values, you can measure the systematic risk. Okay, if you want to invest in a particular company, you can search for the beta values. Beta values is easily available in the internet, or you can calculate it manually or with the help of Excel. You can, there are formula for calculate beta values. Either you can follow a correlation method or regression method, but beta values are readily available. For every share, you can get it from the internet, beta values, and you go for lesser beta values. Then how will you measure unsystematic risk? Unsystematic risk, we usually measure using standard deviation and variance. Okay, I'll show you. Okay, let me stop this PowerPoint and I'll open an Excel sheet and I'll show you how to measure unsystematic risk. Is my Excel sheet visible? Can anyone respond?
Yes, ma'am. It is.
No, ma'am. Yeah. Just now.
Yeah. Okay, this here you can see the calculation of return. Okay, I'll explain that and we'll go to the calculation of risk later. Okay, hope this is clear. Okay, this is with respect to a return from a share. Okay, you can see a table here, right? In the first column, you can see years. This is from 1 to 6th year. And DPS means dividend per share. Then share price is given. And we can have, in the last column, you can see return percentage. That is a total return. I told you, no, there are different kinds of expression for return. This is another expression for return. This is the total return. Last column represents total return. Then the fourth column, you can see dividend yield and capital gain, either gain or loss. And why we segregated total return into two? Because usually return has two aspects like regular return and capital gain. Okay, here also we have segregated the total return into dividend yield and capital gain. Dividend yield is your regular return. Capital gain is the end return. Okay, here you can see share price is changing from year 1 to 6. And dividend yield, how will you calculate dividend yield? Dividend, I'll show the formula, then you can do it in Excel. A dividend yield is calculated by dividend divided by P0. Okay, here I'll show you the calculation. It starts from second year. Dividend yield you can calculate from the second year. Okay, how is it? Here C5 means dividend in the first year. Dividend in the second year divided by the previous year into 100. That is what is dividend yield. Then how will you calculate capital gain yield? Capital gain yield means D5. What is D5 here? D5 is the second year's share price minus previous year's share price divided by previous years. That is P1 minus P0 divided by P0 into 100. Then the final return or total return, you can add dividend yield plus capital gain yield. I hope this is clear. I'll show you the formula once more. Dividend yield means dividend divided by P0. Capital gain means P1 minus P0 by P0. Total return is the sum of dividend yield and capital gain yield. Okay, this is how we usually measure the return of a share. Then okay, you can have average also, average return. Okay, you can find average for dividend yield, capital gain yield, and for total return also you can find, because you have an investment for 5 years, right? Okay, so that you can do like this. One second.
Ma'am, can you show the formula once?
Oh, yeah. Again, please.
Ma'am, can you show the formula once?
Yeah. Can you show it? Can you see? I have gone down. Next, is it visible? Formula for dividend yield and capital gain yield.
Yes, ma'am.
Got it right? Okay. Then, okay, we have discussed about the average return also. Okay, average we can calculate for dividend yield, capital gain or loss, or even for the total return. Then, how will you measure the risk aspect? Risk, usually we refer the unsystematic risk using standard deviation and variance. Okay, for calculating standard deviation, you can use the Excel function. There are two options: standard deviation for sample as well as population. We usually take sample variance. Okay, this is the formula. If you hope you can see the formula here. Sample variance and sample standard deviation. Standard deviation is the square root of variance, right? This is the formula. If you want to do it manually, you can use the formula, or you can use the Excel function. Okay, I'll show you how to use the Excel function. You put equal to here, equal to, then if you want to do standard deviation, you can see the formula, standard deviation, STDEV.S. Click there, then select the range. Hope it is clear. Using Excel, you can find the standard deviation. And like that, you can do variance also. Okay, for getting variance, you put equal to, then variance, VAR. For variance also, you can select VARS, sample variance. Then you select the range. Is that clear?
Yes, ma'am, clear.
Okay. Okay, these are the two expressions of unsystematic risk. Then beta, I told you, no, systematic risk is usually expressed as beta. Beta values are available or if you want, you can do using correlation method or regression method. Formula is available. Okay. I hope it is clear. Is there any
Yes, ma'am.
doubt?
Clear.
Yeah. Any doubt with respect to these two concepts, return and risk? Yeah, I'll sum up the discussion. We have discussed about the basic definition of risk and return, and with respect to return, we have discussed about the calculation of return on investment, return on capital employed, return on equity, and return on total assets, right? Then we have segregated the total return into two: dividend, dividend yield and capital gain. Dividend yield represents the regular return. Capital gain is the end return. So that you can calculate either separately or together as total return. Then how will you calculate risk? Okay, before going to the calculation, total risk can be segregated into two: systematic risk and unsystematic risk. Which is controllable, which is uncontrollable? Systematic risk is uncontrollable and unsystematic risk is controllable. Okay, how can you control unsystematic risk? How can you control unsystematic risk? Using diversification, right? Okay, and you can measure the unsystematic risk using standard deviation and variance, and systematic risk can be measured through beta. Okay, hope this is enough for today. If you have any doubt, you can ask. Okay, shall I stop?
Thank you, ma'am. Thank you.
Okay, thank you for listening. Thank you.